It's my pleasure to present to you the monetary policy statement for the month of August 2022. At the Monetary Policy Committee MPC meeting held on 12th August 2022, the Bank of Uganda, BOU, increased the central bank rate, CBR, by 50 basis points to 9%. The economy continues to face strong cost-push inflation pressures from external environment, dry weather conditions, and exchange rate depreciations amidst weak domestic demand. The annual headline and core inflation rose to 7.9% and 6.3% in July 2022 from 6.8% and 5.5% in June 2022, respectively. Annual food crop inflation continued to rise from 14.5% in June 2022 to 16.4% in July 2022, and annual electricity, fuel, and utilities, EFU, inflation rose from 14.2% to 17.2% in the respective month. The BOU forecast showed that inflation for 2022 remains in the range of 7 to 7.4%. The inflation outlook is driven by the lagged impact of higher exchange rate depreciation, dry weather that has resulted in the sharp rise of food crop prices, and a complete pass-through of global inflationary pressures. The risks to the above outlook for inflation are tilted to the upside, and they include: 1, a further intensification of geopolitical tensions, which could ignite a renewed surge in oil prices; a renewed increase in the oil prices due to the worsening geopolitical tensions; faster policy rate tightening by advanced economies, which could result in higher depreciation of the shilling; continued escalation of global inflationary pressures amidst persistently higher world food and energy prices, as well as lingering supply shortages; and higher domestic food prices should the dry weather conditions become more protracted; and finally, a threat of inflation expectations getting significantly de-anchored. However, there are downside risks, which include weaker domestic household consumption and investment expenditures as tighter financial conditions and higher inflation reduce disposable incomes; emergence of a global recession, which could dampen the global inflationary pressures much faster than currently assumed, resulting in a decline in imported inflation; a rebound in the favorable rainfall across the country, which could lead to bumper food crop harvests; global production and distribution disruptions could ease, and global policy tightening could result in faster declines in energy and goods prices. The quarterly GDP estimates by the Uganda Bureau of Statistics, UBOS, indicate that the economy contracted by 1.6% quarter on quarter in the month of March 2022. All sectors of the economy contracted, with the services sector taking the biggest hit. In addition, the Composite Index of Economic Activity, CIEA, continued to signal a slowdown in economic activity. The growth of the CIEA reduced from a quarter-on-quarter growth of 2.1% in December 2021 to 1.4% in March and June 2022. The growth of the CIEA slowed down to 3.9% year-on-year in June 2022 from 4.6% in March 2022. Overall, economic growth prospects have been dimmed further with the increasing risks of global recession and weaker consumer and business sentiments as high inflation and commodity prices continue to erode household and business incomes and financial conditions tighten. Economic growth is now projected in the range of 2.5 to 3% in 2022, partly reflecting the effects of higher costs of production arising from fuel and transportation on activity. But it will rise to 5 to 6% in 2023, in part supported by public investments and recovery in demand as inflationary pressures begin to wane. The risks to the growth outlook are tilted to the downside, including the emergence of global recession, escalation of geopolitical conflicts, heightened global economic uncertainty, and higher inflation. Other downside risks are further decline in consumer confidence, heightened exchange rate volatility, and extended weakening of investor optimism. In the medium term, the economy is projected to grow in the range of 6.5 to 7%, supported by public and private investments in the oil sector. In the near term, that is 12 months ahead, Bank of Uganda forecasts that inflation pressures will continue to rise. While the current increases in the CBR are meant to bring back inflation to its medium-term objective of 5%, these have led to the indirect effects in lowering the pace of depreciation of the exchange rate, which is expected to cushion the inflation pressures. In addition, the committee noted the recent support from the tightening of the fiscal policy to address the current inflationary pressures. The committee therefore decided to raise the CBR by 50 basis points to 9%. The ban on the CBR remains at plus minus 2 percentage points. The margins on the CPR for the rediscount and the bank rates will remain at 3 percentage points and 4 percentage points respectively. Consequently, the rediscount and the bank rates will be 12% and 13% respectively. Going forward, the MPC considers that the monetary policy stance will have to be tightened even further if inflationary pressures persist to ensure that inflation reverts to its medium-term target of 5%. That marks the end of the statement, and I thank you for your kind attention.